Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Ford stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Ford sells automobiles and commercial vehicles under the Ford brand and luxury cars under the Lincoln brand. The company is headquartered in Dearborn, Michigan and was founded in 1903. The ticker trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, London Stock Exchange, Zicha, Vienna, Euro TLX, Swiss, Kazakhstan, and Sao Paulo Stock Exchange. Let's get started with the model. This is a large cap company, 53 billion market cap. They're trading at $13.45 a share, and they have 3.95 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look how much free cash flow they had in 2020, over 18 billion. It did drop to 10 billion in 2021, and it's down to 4 billion in the trailing 12 months. Net income is a profit or loss on the income statement. It's revenue minus expenses. And they had a negative in 2020, but a big positive in 2021. And it dropped to 11.5 billion in the trailing 12 months. Revenue is a sales for the company, and that dropped a lot from 2019 to 2020, mainly due to COVID and lower demand. But it did jump up in 2021, and it dropped a little in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And their gross profit is a little lower from 2019 to the trailing 12 months. But their revenue dropped a lot, so their margins are up. The way you calculate gross margin, it's gross profit over revenue, and that was 13.6% in 2019. It dropped to 11% in 2020, but then it jumped way up to 16%. Now it's down to 15%. Even if you have lower revenue, you might still have higher gross profit if you're more efficient, if your margins are higher. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Example is marketing and R&D. Gross profit minus operating expenses gives you your operating income. And that dropped from 10 billion to 4 billion. Then it jumped way up to 8 billion. Their margins in 2021 were the highest at 7.2%. It did drop to 6.2% in the trailing 12 months, which is slightly lower than 2019. They have a ton of debt, more than just about any other company. They paid 6.6 billion of interest on their debt, which is a lot lower than prior years. It was over 10 billion in 2019 and 2020. In order to lower your interest payments, either you need to pay down debt or you need to refinance the debt at a lower rate. Below that is other income or expenses. These are all the gains or losses not part of the company's core operations. They have a lot in other income and expenses, 15 billion in 2021. That's why they had such high net income. They actually had negative net income in 2020. Net margins can be a bit volatile due to other income and expenses. You can see they pretty much had no margin in 2019, negative in 2020. Then it jumped way up to 13% in 2021 and 9% in the trailing 12 months. I would probably just focus on operating income or operating margin when I look at the income statement, not so much net income. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generate a lot of cash flow in 2020, over 24 billion. That's the year they had negative net income. They still generate a lot in the trailing 12 months, over 10 billion, but it's still a good amount smaller than prior years. But as long as it's higher than their capex, which it is, they spend around $6 to $7 billion a year in capex. Capex are investments in property, plant, and equipment. If the company needs to buy and build out a new factory to manufacture cars, the cost of the factory and the cost of the machinery goes into capex. And those amounts are carried on the balance sheet and depreciated over their useful lives. Operating cash flow minus capex gives you your free cash flow. And they do have a lot of free cash flow. 18 billion in 2020, it did drop to 4 billion in the trailing 12 months. And in 2021, they paid down a lot of debt. They added 28 billion of debt, but paid down 54 billion. So they decreased their debt load 27 billion in 2021. They increased it 5 billion in 2020 and increased it about 1 billion in 2019. Let's look at the capital structure. 45 billion of equity, 137 billion of debt. They're 25% equity, 75% debt. And their net debt is 96 billion. I gave them the highest whack on Finbox, 16%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 84 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $81 billion. We divide that by 4 billion shares. And we get a calculated stock price of $20. They're trading at $13, so they're trading at a 34% discount. It's a buy according to the model. Their revenue target in 2024 is $169 billion. In 2023, it's $160 billion. In 2022, it's $144 billion. And I continue this growth into 2025, and I got $177 billion. That's how I got their future revenue estimates. They convert on average 8% of their revenue into free cash flow, so I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $39. They're saying it's 65% undervalued. 16 analysts priced this stock, and the average price target is 19, the lowest 12, the highest 32. Here's where the stock has been trading the last 5 years. It was hovering between $7.50 and $12.50 from mid-2017 to the beginning of 2020. Then when COVID hit, the stock dropped to around $4 to $5. I wanted to buy the stock when it hit $4. I was planning to, and I kick myself every day for not doing it because it went up 500% from the bottom. I don't think I would have sold at the peak, but I still would have been up 200% now. The D on the bottom means dividend, so they did stop paying dividends when COVID hit, but they brought back their dividend a few months ago. Before COVID, they were paying 15 cents a share. Now they're paying 10 cents a share. It's a quarterly dividend. The yield is 3%, which is only 14% of their net income, 40% of their free cash flow. Here's their dividend yield since 2011. In 2011, it was below 2%. Then it just kept growing every single year to about 7%. Then you could see here they cut their dividend. They weren't paying anything. The forecast is for the yield to be 3.7% by 2024. Here's a history of the company's stock splits. The last time they did a split was 22 years ago. It was a 1.7 for 1 split. They did another split in 2000 due to a merger. This split in 98 is close to a 3 for 2. A 2 for 1 in 94, 88, a 3 for 2 in 86, 83, and a 5 for 4 in 77. They have a beta of 1.15, so the stock is a little more volatile than the market. It's gone down 13% in the past 52 weeks, while the S&P is down 1%. The 52-week low is 12, the high is 26. And the stock is on a downtrend, trading below its 50-day and 200-day moving average. This is a really popular stock. 50 to 60 million shares are traded each day. Pretty much all the shares outstanding are on float. 54% are held by institutions and 3.5% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd have $20,000 today. That's a 100% return, a 7% annual return. The CEO's annual salary is $1.7 million and their total compensation package is $23 million. 56% of the company is held by institutions, 42% by the general public, and 1.3% by insiders. You generally want to see a company's employee count go up over time, not down. Their employee count was 200,000 in 2016. Now they're at 183,000. The biggest shareholder is State Street at 9%, then Vanguard, BlackRock, Newport, and Geode. Let's look at their financial ratios. They have an amazing PE of 4.6, that's stock price over earnings per share. Much better than a market median and market average. A price to sales of 0.4, a price to book of 1.2, and a price to free cash flow of 13. Their return on invested capital is a bit low at 5%. They can only cover their interest payments 1.3 times with their operating income. They have a high ROE at 26%. They have a good current ratio of 1.2, that's current assets over current liabilities, and their quick ratio is slightly above 1. Quick ratio is current assets minus inventory over current liabilities. They generated $4 billion of free cash flow in the trailing 12 months. They have $16 billion of working capital, and they pay out $1.6 billion in dividend payments. So it looks like the company's pretty well funded. The best way to look at ratios is to compare them to companies in the same industry. There are 33 companies in the same industry as Ford, and if Ford has number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a similar amount in CapEx as Tesla and GM, a lot less than Toyota. They have a bad debt to equity ratio, 3.0. That means for every dollar of equity, they have $3 of debt. They do pay a nice dividend. GM, Toyota, and Tesla do not pay a dividend. They generate more free cash flow than the average company, but a lot less than Tesla, Toyota, and GM. They rank 4th in market cap. Tesla is by far the largest, and their price multiples are amazing. Price to book of 1.2, the average is 4. Their PE is much better than the top 3. Their price to free cash flow is better than average, a lot better than Tesla, but not as good as Toyota or GM. They have the same price to sales as GM, but better than Toyota and Tesla. They generate a similar amount of revenue as GM, a lot higher than average. Their 5-year revenue growth rate is negative 3%. The reason Tesla's stock gets driven up so much is because they're at 49%. Their ROA is 5%, that's net income over assets. ROE of 26%, that's net income over equity. So to summarize, I have them trading at a 34% discount, and I would much rather hold this long term than Tesla. I'm pretty confident Ford will always be around. They played a pivotal role in the US economy for well over 100 years. Not only are they too big to fail, they're too important to fail. Similar to Nokia in Finland, and similar to Rolls-Royce in Britain, Ford, Nokia, and Rolls-Royce have been around for well over 100 years. When you have such a long history, that means you employed lots of people over those years, and you have a really strong brand name. Plus you get that consistent dividend, which is a big reason a lot of people like this stock. The high debt is a little concerning, but it is a good sign they're trying to pay down their debt. They've paid down a lot in 2021. I rank their free cash flow as 5 out of 10, their revenue 7 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on a link in the description below. Thanks for watching.